Welcome back everyone to the Audacious Money Witch channel, where we talk about investing and trading and a lot of fun things. I have to admit that my BABA stock is a frustrating stock to own. I haven't talked about it on this channel for a long time. However, today I saw Cramer give us a hold on Alibaba stock, and he said it's the cheapest stock in the entire world. Well, I disagree. Have a listen.
Alibaba is the cheapest stock in the world, I believe, on growth and also on its breakdown value. Dave Tepper, one of the greatest investors I know, believes this too. I think you just have to hold it right here. I'm not being aggressive, but you have to hold it.
In this video, I want to talk about BABA stock. What's my plan B to hold, buy more, or sell? Also, I want to talk about 5 most frustrating stocks to hold.
It pissed me off.
I appreciate your honesty, Ramon. It's
That's
okay
just
to
one
be
guy's
pissed off.
opinion.
Who else feels this product is stupid? Alan, Lisa, Josh, Yana, Katie. And did it piss off anyone else? Alan, Lisa, Josh, Yana, Katie.
Christina, how bad is this? Be honest. Is this Windows Vista bad? Don't tell me this is Zoom bad.
I'm sorry, Gavin. It's Apple Maps bad.
And who else felt this product is messed up? Alan, Lisa, Josh, Yana.
Spoiler alert, some of them are Jeremy Financial Education's top stocks at the time.
Listen to this. I've put $800,000 into this stock in just the past 30 days because I believe it is such a no-brainer stock, it's not even funny, okay? It's like a beaten down stock, super low valuation. Everything is gonna come together for the stock at the perfect time, okay? It's the perfect storm, but in a positive way. Super low valuation, and I mean super low. They have a turnaround going on.
Why are the cheapest stocks sometimes the hardest stocks to own? Many people constantly tell me that Alibaba stock is a trap and won't recover. This fear is common during market downturns. Investors often panic and sell, only to regret it later when prices rebound. As Warren Buffett famously said, the stock market is a device for transferring money from the inpatient to the patient. China's current economic situation, with its plummeting property prices and a struggling car industry, has led to significantly undervalued stocks. While some investors are scared, I see a great opportunity. You have the chance to buy one of the world's biggest companies at a discount. Remember, China built the world's largest railway system in record time, and their growth continues. Many countries take years to achieve similar feats. I think a lot of the biggest companies have built their foundation in China, like Apple and Tesla. Of course, bulls can think this way when they are holding BABA.
Are these stocks value traps? Are these traps for your money? Are these stocks that if you invest in them, you're going to likely not even perform as well as the S&P 500 over the next few years? Are they a waste of, let's just call it a capital in time? I've invested in plenty of value trap companies over the past 15 years. So when I put Alibaba and when I put PayPal into the value trap category, I just wouldn't. I just don't see the telltale signs of a normal value trap that would make these a value trap.
However, Alibaba is not a U.S. company. Its headquarters is in Hangzhou, China. BABA stock is just an ADR. It's not your average Tesla shares that represents you own a piece of company. Alibaba is a Chinese company in China. The state owns most of the largest domestic companies, so I don't think you actually own a piece of Alibaba Group. You can trade it, but you don't own it. This is why Alibaba stock is on the list of the top 5 most frustrating stocks to hold. So number 5, Alibaba, one of the most frustrating stocks to hold. I am looking at it from a 5-year basis. BABA stock is down 58% in the last 5 years. One stock I must point out in the last 5 years that devastated the performance of Alibaba, it's PDD stock, their strongest rival. They have the Temu app that is currently running ads like crazy. PDD stock is up over 500% in the last 5 years, and they are backed by the Chinese government. This makes the Alibaba holder even more frustrated, I am sure, because I was one until I sold it back at $88 a share. I averaged down when the stock was down to $69, so I made double-digit percentage gain in the 9 months of holding the stock. The main reason I sold it is because when I listened to the conference calls, they used AI to translate from Mandarin to English, so you don't even know who you're listening to half of the time.
My question is regarding the AliCloud business. It's encouraged to hear from management that we expect it to resume double-digit growth in the second half of the year. Could management please share some of the composition of the revenue growth driver behind? How much of the improvement in growth is coming from AI-related products? How much is it coming from public cloud, and how much is it's coming from low-margin private cloud projects becoming a smaller part of the business? And then also related to that is once we are back up to the double-digit growth level, how should we look at the kind of medium-term margin for cloud business going forward? Thank you.
好，谢谢，我来回答一下这个问题。我们会期待于在未来的几个季度，我们在公共云和 AI 相关的收入带来的更大的增长，同时能够去抵消我们已经在减少的这些我们的低毛利的这些项目的收入。
Thank you. This is Eddie, and I'll take that. If you look at the overall revenue growth of the cloud business today, most of that is already being driven, I would say, by AI and AI-related new products. We expect revenues to grow faster, primarily driven again by public cloud and by AI-enabled offerings, and we expect that we should see that a complete disappearance of that drag within, say, 1 or 2 quarters into the new year.
Who is Eddie Wu? He has never done any interview with the major media in the US. We don't know who this CEO is, frankly. So I sold out of the stock in May. If you hold this stock, good, because Michael Burry and Charlie Munger are still holding it. Burry is adding more and Munger is cutting more in their position. Yes, I do know Munger is holding it in heaven. This is just my opinion. You probably know more than I do, so this is not financial advice. Okay, so number 4 of the most frustrating stocks to hold, it's Zoom stock. A stock Jeremy just said he is going to buy Zoom stock in July.
I never thought I would be a buyer of Zoom stock, but I just bought my first shares of this one very recently, and I would actually like to build this out to a decent sized position.
It is an interesting Cathie Wood stock. The problem with Cathie Wood stock is that Wall Street tends to ignore it intentionally, which is why the stock is just stuck at the range of this 60 to 70 price range. Recently, though, it broke down to $57, which is making a lower low, resuming the downtrend, which could be a hard pill to swallow, because the business is doing more than okay. They have never missed one earnings. Their revenue is slowly growing at 3%. They are not losing money. They have $7 billion on the balance sheet. So why does the stock keep on going down? The competition, they are competing with Microsoft, and Microsoft has higher revenue growth than Zoom, which is why Wall Street tends to just buy the big trillion-dollar names and ignore the mid-cap companies like Zoom. Will I buy Zoom? Nope. The reason is when you look at the PEG ratio, it's sitting at 4.75. Based on the growth of this company, it's not as cheap as you think. All right, number 3 of the most frustrating stocks to hold is Unity Software. I am glad I have never bought into the ticker symbol U stock.
And if you want to do something wild and crazy and beautiful and inventive online, check out what Unity did last night. This is a company that makes software tools for video game developers. But last night they brought the tech division of Peter Jackson's Weta Digital, which handled all the cool visual effects in the Lord of the Rings movies, not to mention Avatar. Imagine being able to be an avatar of the person who made up the Avatar. I mean, that's real Avatarium. These are companies that are currently doing the best work in the metaverse.
This stock is down 61% year to date. Brutal. For the people that bought it at $25 a share when the 2022 tech crash happened.
Jim, I'm down 50%. We hit a 52-week low today. Do I hold, sell, or buy more Unity software? You.
Man, I'm telling you, that is just a falling knife, and you are not a butcher block from the description. I'm going to imagine you from that voice. You do not look like a butcher block, so I'm going to say, let's stay away.
This stock was the top metaverse play. I am glad that I was sticking with the good old meta stock and didn't look at this U stock. There were a lot of problems for this stock to be down 70% in the last 5 years. From what I observed over the years, they have ongoing management issues. They are losing money, their gross margin is going down year over year, and they have more debt than they have cash. Which brings me to number 2 most frustrating stocks to hold, and it has a balance sheet issue, which is Jeremy's WBA stock. Yes, Walgreens Boots Alliance.
Ticker symbol on this one is WBA, Walgreens Boots Alliance, all right? Which for reference is me adding very aggressively. I don't usually just buy that much worth of shares in that short of a period of time.
And I would say that one is cheaper than BABA, the cheapest stock in the world, in my opinion. The stock is down 58% year to date, 80% down in the last 5 years. Jeremy used to think this stock as a dividend play. He bought it in the 30s. He used to brag about how much dividend he was making on this stock. He thinks, well, let me park $1 million here. I am going to get that juicy 8% dividend back then.
The stock, WBA. I'm buying about $1 million worth of stock, okay? I'm going to make $1 million in the stock, in my opinion. And I also think there's a very, very low probability that I lose money. So if I put $1 million in the stock, I think there's an extremely low probability that that million goes to $500,000 or $750,000 over the next few years.
Now the stock is giving out 13.5% dividend yield. I don't think they can give that dividend for long because they have $32 billion in debt. What's the point of getting 13% dividend when the stock value was just cut in half? If you think your $1 million can generate $135,000 in a year, think again. Now you just lost $500,000 in your portfolio. This type of value trap stock is going down because millionaires can get 5% on a T-bill with no worries. Without further ado, let me get into the number 1 most frustrating stock. This one is a famous stock because of Jeremy too. It's GoPro stock. I think even Jeremy agrees that this was the most frustrating stock to own.
Have you ever felt like you have been used and abused? Are you a GoPro shareholder? You know, and for the stock to still be down here, it's amazing to me. With the growth GoPro has, with the focus on profitable growth, you know, it's frustrating. It's very frustrating.
Just when you think it can rebound in 2021, it's traded for under $1.50 right now. It's still losing money, and sales are declining too. Full disclosure, I don't own any of these stocks mentioned in this video. You can settle on a city, a house, a car, or a girl, but don't settle on a value trap stock because a house you can live in, a car you can still drive, and a girl can give you a hug too. But a losing stock can only give you losses. Now you know the most frustrating stocks to avoid on my list. What's on your list? Let me know in the comment section below.